Hello, everyone, and welcome to another episode of our market volatility webinar, A Sense of Calm in the Midst of the Coronavirus. So thank you for joining us today, and happy Friday today to you, this last Friday in May. We were with you 2 weeks ago and gave you an update, and we said that we would continue to do this every other week unless other things have come up that we would want to bring to you and update you, and we certainly want to continue to keep you updated. So a couple reminders. One is if you have questions and you want to submit them, you can do that right on the screen there. Type us your questions, and we'll be glad to get to those questions. So that's important. And another reminder is if you missed our webinar last night at 6 o'clock with our cybersecurity expert, Robert Siciliano, you can look for a communication and catch a replay of that very soon. It was an excellent webinar, and you get a lot of great information. So with that, again, Bill, Beth, and Matt are all with us today, and we're all distancing and in many different places today. And so let's go ahead and jump right into the agenda. So we really have three key points here today. First one is the market has stabilized. Number two is price earnings ratio. So we're going to talk a little bit about that. You know, in this discussion under price earnings ratio, it could get pretty deep into the weeds, so to speak, rather quickly, but we want to just talk about it and maybe how we think about it. We're also going to talk about the changes that we made in the portfolio, in our portfolios, and we had sent out a communication to you recently, along with a video that Matt had done, a short video explaining it, but we thought we would talk about that briefly as well. And then we're going to talk about the unemployment and layoff that are starting we're going to see more and more of those. So that's really what we want to cover today. So the markets have stabilized. So Bill, you know, we've talked as a team here over the last many weeks. We've been doing this now since March. And we've talked about a trading range and some more stabilization in the market. And it seems as though, at least over the last couple of weeks, we've started to see that.
Yeah, absolutely. I'm feeling a little more confident even over the last month that we're establishing some floor to the overall global market. I think we have a chart of the SPY ETF. And so you see some flattening of the numbers, but we're always looking to find the floor and the ceiling. So I think we now feel pretty confident in a floor of about 272 on the S&P and about 23,000 on the Dow. So that, to put it in layman's terms, shows about a 10% downside risk of a pullback. And we're going to get into that a little bit on why we think there could be a pullback with the high PEs. But I have a lot more confidence now that we understand that we probably have about a downside risk of 10%, which in a moderate portfolio, you know, you could see a downside of maybe 5%. So to just give a little bit of a sense of confidence that if the market does what we think it will do, it shouldn't have too dramatic of a negative impact on our clients' portfolios, since I think a lot of our clients kind of run that moderate Hilltop Wealth Solutions moderate portfolio.
Yeah, thanks, Bill. And you know, Beth, we talked about the VIX on this webinar, and we really have seen that even drop a little bit more, which is a measurement of volatility.
Yeah, it's a measurement of forward-looking 30-day volatility. And when we first started talking about the VIX, I've completely lost track of time. When you said we've been doing this since March, it feels like it's been years, but it's only a couple months. When we first started talking about the VIX and introduced that as a data point, we were at 42, and the VIX is currently at 29. So it has come down, and the consumer sentiment report coming out of the University of Michigan, which you know is an ongoing data point for years and years, is positive. for the future. And I think that reflects the fact that the economy, cities and states are opening back up. We're going to talk a little bit about unemployment in a minute, but people are going back to work. Consumer spending has increased. And so all of those things are positive moving forward. And I agree with Bill that we found this trading range, and in my opinion, I think it's going to take something truly shocking to push us back to where we were end of March or so, but ongoing volatility, because there's still a lot of unknown in the near future.
Matt, and one of the things that we had a question come in, which I think is a good question, because people are thinking, okay, is this a buying opportunity? And we were talking as a team and just how much cash is on the sidelines. So how are we thinking about that right now?
Yeah, there's about two trillion or so that has been moved into money markets within the last 18 to 24 months. Year to date, actually, the only asset class where we've really seen a pullback is in the fixed income space. So equities, people have done a really good job of keeping their money parked. Buying opportunity, if you buy the right thing, I would say yes. I think if there's a lot of things, in my opinion, that are pretty significantly overpriced. And momentum has really driven those prices up. Concern that they've missed the bottom have driven those prices up. But when we take a look at forward earnings, I mean, earnings right now don't justify where the market's presently priced, which kind of concerns us a little bit. Not overly concerned, but at the same time, we're saying, hey, we're cautiously optimistic on this. That would be my initial thought is depending on what you're buying. Yeah, I think there's some opportunity, but it's not something that I'm saying just go willy-nilly and throw a whole bunch of money at something hoping that it goes up.
And we've been using the dollar cost averaging. It was we felt as though over the last few weeks, maybe early May, if there's wanting to get back in the market, is kind of tiptoe back into it. But one of the reminders that we wanted to bring up to everyone is, we have second quarter earnings coming out. Believe it or not, it's a little over a month, and we know that is just not going to be pretty. So it's going to, and some of it certainly can be built in. And of course, some of it could be really due to COVID-19 if we see kind of a respike or resurgence, which is somewhat the unknown. So, well, Matt, you mentioned the price earnings ratio. So let's let everybody digest this next chart, because it's pretty busy. In fact, when we saw this chart, we see literally dozens and dozens of them, and you can see there's a lot of dots there. Kind of looks like the solar system or something like that. So Matt, maybe you can walk people through this, because we thought it would be just something that would be of interest as we think about it as it relates to risk and earnings and so forth.
Fair enough. So the left-hand column just kind of gives a 1-year forward PE. The right side of the chart shows a 5-year moving forward PE. And so, and the red arrow is nothing more than current PE price levels for the S&P, which as of April 30th were right at 20.3. Those are actually higher right now with the run up in May that we've had, and no earnings to support that. But if you were to take a look at where PE prices were at in March, February, before we had the pullback, they're actually a little bit lower than where they are now. So we're actually priced at a higher dollar amount PE ratio wise in May, April, after the index declined, versus where they were in February. So that to me says what is justifying what the current prices are at. We think we're probably in a little bit better shape than we should be. And a lot of that has to do with stimulus, government money. And I think people just being resilient, that the market was doing really well until a virus came along. So this is basically just showing you, though, that the variance over 1 year is going to be all over the place. Those little gray dots are your S&P 500 companies. And so you're going to have some that definitely outperform. You're going to have some that don't. when you go to a 5-year moving average of the PE at that price, what it's suggesting is that a lot of those companies won't have any profitability. So over the course of 5 years, we won't see any share price growth, or we'll see it for a year and then we'll see it pull back. And so what that tells us is that what you need to own is you're going to have to pay attention to what you own. You can't just own everything. And so, a lot of the ETFs that we employ in our portfolios have algorithms to help eliminate a lot of those stocks that we just don't believe are going to do well, which is definitely helpful. But what we're saying is curb expectations on, another 10-year bull market like we had after the last recession. Mainly because when we came out of that recession, PE prices were down in the 12 to 13 number. So there was a lot of room to run. So right now we're just feeling a little bit overvalued. That just says, hey, calm expectations. And it also it justifies the need to move to owning asset classes outside of traditional stocks and bonds, because there might not be as much money to be made over the next 5 years if you're going with just straight stocks. And so again, most of our strategies already have 30-35% in asset classes that are outside traditional stocks and bonds, and we believe that going forward is going to be something that really helps provide consistent returns.
Thanks, Matt. And Bill, since we're really looking at going, the markets aren't really lining up with what's going on Wall Street. Do we really now know how big the Fed actions and the stimulus package and, how big a role that played in kind of that dip and coming back?
Oh, it played a huge role. I mean, just making the bond market liquid, even covering the high yield market that was, no one ever thought that the Feds would infuse capital into the high yield bond market, which we just exited from, looking at what's coming up with potential defaults in that category. But I'm not certain that we would be where we're at today without the infusion of capital that the Feds put in.
Bill, there was Jay Powell had a speech that he gave or presented to at Princeton University this morning. And in that, I think it was Jay Powell, is it the Jay or the head of the New York Federal Reserve, said that they crossed so many red lines to make that happen, red lines that never would have been crossed before, to make all of the activity that they did eventually utilize happen for us. So unprecedented on the part of the Fed. And I think time will tell if that was the savior of this, or maybe it just prevented things from being worse. But that was an interesting point to read, that even the Fed is admitting that they took chances that had never been undertaken before to do it the way they did.
Yeah, and I think the opposite side of this coin is that infusion of capital, Erik, has also what has supported the higher stock prices and driven up the PEs. So that's just another piece of this whole puzzle. That okay, why has the market gone down 30 and back 25, back up 25% or 20%, whatever? It's kind of like Katie bar the door, because everybody's backed up by the federal government. And so when that stimulus starts to dwindle, I think there's still some stimulus coming out. I understand they're still accepting PPP proposals because a lot of organizations have returned their money because they were getting a little bit of heat that they didn't need it, and they took it, and that would include some universities.
Yeah, I mean, I think when you look back, I mean, the analysts and economists and most everything they did, they were very positive on it. And, the Fed had said that, they learned a lot back from 08, 09. And I will point to, you can reference on our website in the market volatility section, that we posted another interview. This one was with the Fed chairman, actually, Chairman Powell, in a 60 Minutes interview a couple weeks ago. And he talks about in that interview, it can scare you a bit, but on the other hand, he talks about they have a lot more tools in the toolbox. And then the other thing I think that was a big deal, I mean, if this global pandemic would have happened even 10 years ago or longer, you know, we were not nearly advanced in technology, and people being able to work from home and work mobile. And so that certainly helped. So, you know, one of the things we do every quarter as an investment committee is we meet and we talk about all of our clients. We talk about each of you, and we talk about our portfolios, and we get outside views. So we have partners that we work with, like BlackRock and other partners, on how they're thinking about it. Oftentimes we will pull in one of the fund manager teams or someone from some of our partners that we utilize in the portfolios. And, you know, we determined that we wanted to make a couple adjustments within the portfolios. This does not change risk tolerance, but we wanted to make a couple adjustments. So Matt, why don't you just give the folks a little highlight on what we did there?
Yeah, quick highlight. You know, we decided to, which was kind of a tough one, to eliminate the high yield bond space for the time being, primarily due to you know, it's corporate debt, and it's low quality corporate debt, which we believe at this point is going to have a significant increase in defaults. And so as those defaults go up, you know, we're looking at north of 10% of the default rate, and we're right now around 3 to 4. That's going to have a significant impact on performance. The yield that you're getting isn't going to offset the share price. And so and looking into just kind of going back to like a PE of, hey, where can we go that has opportunity to make money in a non-traditional world? And commodities was a spot that we believe we can do that. But we didn't want to be long only commodities. Long only means that you just buy it. If the price of the commodity goes up, you sell it for a profit. We actually wanted the flexibility to own both sides of the equation. So the long short commodities that we went into does that. And in the commodities are going to be things like energy, oil, currency, interest rates. It could be materials, metals, you name it. So very diversified. There's 4 portfolio managers on that. And we feel very confident that that's going to be a place that allows us to capture profit in time that traditional stocks and bonds are going to have a lot of volatility.
So I remember back in the day when, and I know all of you would, when the high yield bonds were referred to as junk bonds. Now they don't say that, because who wants to buy junk? But thanks, Matt, for that update. You know,
that's what I was going to add, Erik, was just to be clear that is junk rate. That is below B, triple B junk bonds, and they act very much like equities and pay a high dividend, which was helping the portfolio dividend. But and we had ridden out the junk bonds for a really nice 10-year run.
Yeah, that's good. That's a good point. And like you said, Bill, they you know do act like equities, and we just feel like that, you know, the fact of the matter there is there are going to be a lot of defaults, and, you know, companies closing and right sizing, and you know, all of that. So so I think that's important. So
I think most everybody had a 5% weighting in high yield bonds, so now they have a 5% weighting in commodities.
Yeah, it's so we made that change. We feel great about that change. So okay, so let's talk a little bit about really now what we're starting to see is, you know, obviously unemployment numbers continue to kind of get added to, you know, now in a clip of a couple million a week. You know, many of the unemployment claims, I think there was a number, and anyone on the panel can correct me, I think it was about 90% of unemployment claims during this pandemic they had indicated they believed it was temporary. I believe that was a number.
I don't remember that one exactly, but I think that is part of this waiting to see what things are temporary, what things are permanent. I think the number that we were talking about yesterday a little bit is sustained unemployment claims. Are they going up or are they coming down? And we had this new unemployment number yesterday of 2.1 million, but underneath that, we had a reduction of 4 million people coming off unemployment. So surrendering, going back to work, not having being on benefits any longer. So I think that that's going to be a number that we're going to be watching going forward until we look at a list like this of companies that are doing significant layoffs as they are anticipating what their future will look like once the stimulus wears off and they don't have that influx of money coming in. So this is pretty dramatic to look at, and where those unemployment numbers could be over time and how permanent they're going to be.
Yeah, so we just wanted to share some of the highlights, and actually, in putting these numbers together, it could have gone into more pages. And so you see some of the larger companies, when we're talking about Chevron cutting, 10 to 15% of its workforce. So an upwards of 5,000 to 6,000 people. Boeing going to lay off more than 7,000. And Boeing, Matt, maybe you could talk just briefly about they had received some stimulus money, and there was a kind of an agreement there, right, that they would keep people employed, and they decided to still lay people off and deal with it later.
Right. I mean, Boeing, United is another one, right? So the deal is you basically keep them employed through August, September, and then you don't have to pay back the government stimulus money, the bailout money. But they're burning through cash, and so they've already made announcements. United in particular, trying to entice. American Airlines also yesterday came out trying to entice people to take early buyouts, early retirements, voluntary leave, if you will. And we're seeing already Democrats and Republicans both coming out saying, whoa, that wasn't the deal that you made. You were going to keep all these people employed. And they're basically saying, we can't afford it. So it'll be interesting to see how some of this unravels, because now they've gone back on their words. So now they're going to have to pay that back with funding that they don't have already. So I think a lot of these industries are going to be hurt pretty deep for a while, whether there's government money or not.
Yeah.
What's interesting is, when this started, we were at above full employment. I mean, we had never experienced as a country as low of an unemployment rate or as high of a participation rate. So it's going to be really interesting to see where these people go, because where we were was companies couldn't find employees. Now there's going to be a lot of qualified workforce that's going to be shifting, maybe even shifting industries. It's going to provide, it provides opportunity for these companies like these that are on this graphic to kind of weed out some employees possibly, but it's also going to offer some good employees opportunities at other industries and other good solid companies that are going to be getting a good solid workforce becoming available to them.
That's a good point, Bill.
Yeah, it's a good point. Really good point. Okay, so let's look at kind of our key takeaways here. We almost put up it's kind of a ho-hum right now. I mean, it feels as though, summer, hopefully we're getting out, enjoying the weather. And right now, one of the first takeaway is carry on and sit tight. We're not saying certainly that it's over. We've seen less volatility here over the last few weeks. We've got second quarter earnings coming up in July. You saw just one slide of the layoffs. So any of the panelists have a comment on that?
When I say carry on, I think about maintaining, your financial plan and prudent decision making, and knowing where you're at, cash reserve, long-term savings, not and something we've been talking about since March about this, not making emotional decisions. So carry on. There is more information to come. There's things that we don't know yet. Will there could be a continued resurgence in infections? Will companies like Ford that opened up plants and then had to close them 2 days later again? Know where you're standing, what you're looking like, prudent decision making. So when I see carry on, that's what I think. Carry on, do what you're supposed to do. Be aware of your situation. Wait for more information to come as it evolves and develops over time.
And for me, to sit tight tells me continue to be a little bit heavy in cash, that buying opportunities will come. I think they'll come in technology, healthcare, and small caps.
Yeah. Good. And it could be worse than the markets. Matt?
I don't want to be pessimistic.
But it could be worse.
It could be a lot worse. It's actually been enlightening looking at having some meetings this week and looking at clients' accounts with the last 12 months rolling average, and their accounts are positive. So I think over the last 12 months, if you're still around 1 or 2% down to a few percent up, that's a good place to be given everything that's going on right now. So I'm pretty thankful for that. And it could be a lot worse. We could be down 25%, 30% still.
I think the phrase "it could be worse" is the most common thing I hear in my client meetings over the past couple of weeks. We look at those numbers, and inevitably, in some form or another, the folks sitting across the Zoom conference from me are like, well, I guess it could be worse, and or it's not as bad as I thought it would be. So I think it could be worse. It could be a lot worse.
Yep, exactly. Great. So the last thing we want to leave you with is we want to remind you of our Together We Can Make an Impact program that we are doing to try to help out those in need, particularly around the COVID-19. So we encourage you. We've gotten some good response, and we want to continue to have response. We encourage you to make a donation. Remember that an individual taxpayer can take a $300 deduction this year. So if you're a couple, that's $600. You'll be able to take that right off your taxes in 2020. And so these are the charities. You can find more information on our website. And when you make a match, we will make a contribution as well as a firm. And so you just need to submit those receipts to us, and we want to help out. So with that, we are going to wrap it up. I want to thank, again, Bill, Beth, Matt, everybody for joining us. Our next session will be on June 12th. And I hope everybody has a great weekend, and we will see you soon. Thanks so much.
Thanks, everybody.